Hi, welcome to this podcast where what I'm going to be looking at is incomplete records and in particular how we can use ratios. And I'm also going to build that into how we can use ratios to help us to work out if it's likely that any inventory has been stolen from a business. So first of all, the absolute basics. Okay, here we've got a business. Cassim is a trader and provides the following information. So he knows his sales, he knows his purchases. He knew his opening inventory, but he's lost his records for what his closing inventory was on the 1st of Jan. But fortunately, Cassim runs a shop and he always marks his goods up with a markup of 40%. So at the moment, what we know in our income statement, we know what our revenue is. We know our opening inventory because he must have known it for last year's accounts. We know our purchases because we can go through all the invoices and find out what's been purchased, but we don't know any of this information. But fortunately, because Cassim always uses a markup, what we can do is we can use a grid to work out both what his gross profit should be and what his cost of sales should be. And I've got a similar grid down here for doing a gross profit margin question on similar lines. So there's something that we need to remember. If we're marking goods up, the selling price goes up from 100%. So the selling price percentage is going to be 100 plus whatever the markup is. So we know that the selling price is 100% plus 40%, so 140%, and we know that the selling price in terms of value is 210,000. What I also know is that the markup itself is the gross profit. It's the extra that's been added onto the sales to give me, onto the cost of sales to give me the selling price. So if I know that the selling price is $210,000 and I know that my percentage for my sales is 140% of the original cost price, I can find out the gross profit by doing 210,000 divided by 140 and multiplied by 40. So that gives me a gross profit of 60,000. And I can do a similar thing to find out my cost of sales, because if I'm marking up, my markup of 40% was based on increasing the purchase price by 40%. So the purchase price has got to have been 100%. So I do a similar calculation. I do my selling price, which I know is 140%. I divide that by 140 to find 1%, and then multiply it by 100 to find my cost of sales, or how much the goods that have been sold cost this business to buy. And I can do a double check now to make sure that I've done it correctly, because my 100% figure is 150,000. Add on my gross profit, 60,000, and that comes to the selling price or the selling revenue. So I've done it correctly, and now it's quite easy because I know that my cost of sales is 150,000. I know that my gross profit is 60,000. Okay, and looking up here, I know that my opening inventory plus my purchases comes to 170,000. I know that my actual cost of sales is 150,000. So I know that my closing inventory had to be 20,000 because I've done 170,000 take 150,000. Pretty simple. Okay, you've also got to know to do it when we have a similar situation, but where we've used a gross profit margin. So in this situation, the sales or the revenue is 210,000, the purchase is 130,000, the opening inventory is 40,000, but he doesn't know his closing inventory. So this time, because we're using gross profit margin is worked out on the selling price. So this time, the sales are going to be 100%. We know the gross profit is going to be 30%. And we know the cost of sales, therefore, has got to be the difference between 130, which is 70%. I can put my revenue figure in. 210,000. I now want to find 30%. Just to find 1%, I do 210,000 divided by 100, and then I multiply that by 30. So my gross profit for this business is 63,000. I can put that straight into my trading account. And I also know that my cost of sales is going to be 210,000 divided by 100 to find 1% and multiplied by 70 to find the cost of sales. So that comes to 147,000. And when I've done that, I've already put in, as with last time, I've already put all the other information to my trading account. I know that 40,000 out of 130,000 is 170,000. So that's my subtotal. And then what I need to do, I need to subtract the closing inventory from 170,000 to give me 147,000. So I know that that figure has got to be 23,000. Right. Pause the video now. You've got a sheet with a couple of questions for you guys to do. I'm sure you'll enjoy them. And then we're going to use the same technique to show you how you can work out if inventory has been stolen from a business. Okay, part two. What we've now got is a small business run by somebody called Jay Rotten, and he sells goods with a 25% markup. And he's being concerned that an employee called S. Vicious has been stealing his inventory and has asked you to investigate. And he provided you the following information. We know that the sales were 250,000. He knows his opening and closing inventory, and he knows his purchases. So the first thing we can do, we can just do a very simple trading account. So I've put all the information into a trading account. It's the same as you've been doing for some time if you're watching this video. And that gives me a gross profit of 45,000 and a cost of sales of 215,000. And now what I can do, I can use this information along with the markup information to calculate what my cost of sales should have been. So I can calculate what this figure should have been, provided his markup has always been 25%. And because we're doing markup, the percentage of the sales is up from 100%. And in this case, it's marked up by 25%, so it's 125%. My gross profit is going to be 25% because the gross profit effectively is the markup, and the cost is going to be 100% because the cost is always 100% when we're doing a markup question. So put the sales in, 250,000. Okay. I then do 250,000 divided by 125 to find 1% and multiply by 25 to give me my gross profit. And I do a similar calculation to find out my cost of sales. So 250,000 divided by 125 to find 1%, multiplied by 100, that gives me a cost of sales of 200,000. Now we've got a problem. The cost of sales has been calculated, it's 215,000, but the actual cost of sales using the markup should be significantly less. So if I do 215,000, subtract from that 200,000, and that says to me there's a problem because there's 15,000 of inventory that's unaccounted for. And it could have been stolen, it could have been lost, it could have been damaged and not recorded correctly, or when they've done the stock check, they could have just missed something, but there's certainly an anomaly there that we need to look at. A couple of questions for you guys to have a go at. I've done a similar type of question where we've got a markup and there's been some goods stolen or lost or not recorded properly. And I've also done a second question where you've got to use gross profit margin to do the calculations. So you need to think about that, think about what we did at the start of the video. Hope that covers everything that you need to know. You've understood it. For people that I teach normal routine, you've got the spreadsheet sent to you. I want you to complete the questions, send them back to me, and good luck.